Government contract financing is changing, and most government contractors aren't even aware of it. I recently had the chance to sit down with two experts who are rewriting the way government contractors access capital, and here's what they had to say. Charlie, what are some of the things you think that people can do before they realize that cash has become so tight?
Question I think is better phrased is that most people don't realize that the cash flow problem is on its way. Everyone's running their business day to day, and they don't really see the problem coming down the pike. Our technology actually could spot that for you, right? Because the problem lies in you have invoices due that you need to pay, and you have money that's owed to you. It's the old, take from Peter to pay Paul scenario. So you don't know when that payment's necessarily coming in from the government. You may or may not have invoiced them yet. But prior to that payment coming in, you owe money. Our system actually can see that problem happening beforehand, since we're tied into the contract backlog, into the view only of your bank accounts, and into your accounting system. So we're able to tell you ahead of time, hey, there's a cash flow problem coming, so you can prepare for that.
Talk a little bit about the life cycle of the contract, of the government contract, Eric, and where does usually the cash flow become the biggest problem?
Yeah, so I would break it down into 4 phases, and I think the one that hurts the most is the one nobody plans for. So pursuit, you're spending capture, money on capture and proposal with no revenue. From award to the notice to proceed, you have to start doing things like background checks, waiting on clearances, all of that before you can bill a dollar. Performance starts, and then that's the healthy phase. If your rates are right, you price the contract correctly, your invoices allow you to recover direct and indirect expenses. But that acute gap is in phase two, which is in mobilization. And so that's where you're incurring costs at a full run rate, and you're not billing anything yet, or at least waiting to get paid for what you've billed. And that's the thing I want every owner to hear. Steady state works, the math is good, but getting to steady state, that's what puts companies out of business. The other thing is, the bigger the award, the deeper that problem runs.
How and when should these small businesses start thinking about financing as a growth strategy?
I think the answer to that is there's never too early. You could start thinking of that from the very beginning. So even before you bid a contract, right? Like, how much do you have? There are costs that are going to incur on that contract before you submit invoices to the government. So it's the old catch-22, which is you need money to win a contract. So if day one you need to buy supplies, or 2 weeks in you have your first payroll cycle, 2 weeks after that you have your second payroll. Now you're first submitting an invoice to the government, and you're waiting 30, 60, 90 days in some cases to get that money back. And once again, you're hit before you even get that payment with the next payroll. So I think from a growth perspective, and a bidding on contracts in general, it's never too early. You want to look at that even in your business planning stages.
Why are sometimes traditional banks not the best route for fast growing businesses?
Traditional banks will always look backwards at your financial statements, your balance sheet. They're looking at, a lot of times, you as an individual, not necessarily the business. So they're looking at your credit score, which really inhibits growth a lot. It doesn't allow you to, I say, punch above your weight. How do you bid a larger job if you just don't have the capacity? And the banks really don't understand that. If you ever have been to a bank, they usually lend money to people that don't need it. And when you really need it, they don't lend it to you. So I think it becomes problematic with the bank, mainly because of the limits that you're given, because you're given the limit to stay essentially the same size that you are. So if you're bidding a particular contract amount and you go to the bank, they may give you money to cover that contract, but then it prohibits you from bidding a larger contract.
What are your thoughts on that, Eric? Can you give me any thoughts as well?
Yeah, of course. Frankly, I think banks are bad at this, and this is lending to federal contractors. I think, fundamentally, I think banks are built for a different type of borrower. And I would know, I started the government contracting vertical at Live Oak Bank, and it was a constant battle with my credit team. And I love the folks over there, and I don't mean to cast shade on them, but the fundamental difference is the way they underwrite the deals. They look at the balance sheet, last 3 years of tax returns. Charlie just mentioned it, but it's really looking at what did you already do? But a federal contractor's value isn't necessarily on the balance sheet. It's on the award and their ability, their past performance, their capabilities. So that's where we're able to look at that and really get a sense of if the vendor who's applying with us is going to be a good fit. I think the concentration problem, like if your AR is 100% tied to one customer and a credit committee flags that, that's going to be a really hard sell for that credit committee. The fact is, the U.S. Treasury Department, they're not known for missing payments or running out of cash, and so we have a lot of comfort in that. The other thing I want to add is the timing. If the notice to proceed is in 3 weeks, and then the credit committee hasn't even looked at the deal yet, the likelihood you're going to get approval, even if they can say yes, the timing from when they say yes to when you need that cash, that's another big problem too. So I think banks just tend to be slower in terms of how fast these contract processes can work in practice.
Charlie, you shared a really interesting story with me last week about your dad and his small business, and I think you hit the nail on the head. I think one of the best things we're seeing now is technology and how that can really sort of forecast, take a look at some of these problems, catch these problems ahead of time. So, just give me a generic thought from you, kind of where you are, how technology is actually making the identification of cash flow problems much quicker than your dad's times.
Oh yeah. So yeah, in my father's times, everything was done on a notepad in a book, and I think it's a lot of ways some banks still work in that in that way, right? It's they request balance sheets, which are printed out or in a PDF format. They'll request financial bank statements, from that you have to print out from your bank and sometimes scan or email, right? Now with technology, there's a lot of platforms that you're able to see inside people's bank accounts. Plaid is one in particular. And there's also API calls where you can call specific data from other technology platforms. So I think that, you know, as technology advances and you're able to see inside of people's real-time accounting systems and banking systems, as well as with the advent of AI and artificial intelligence, being able to read these and analyze these and summarize these documents, I think really is creating a whole new marketplace for fintechs and for lending and solving the cash flow problem in a whole new way.
What's the biggest cash flow mistake you think government contractors make? And if we can put that a little bit towards technology, I'd love to understand that. Maybe they're not looking ahead or
So I would say the biggest problem or the biggest mistake they make is waiting until they need the money to go get the money. So for example, we'll get calls after an award is made. Sometimes it's after a notice to proceed, and the money's needed in 2 weeks. And that's just not generally how it works. And what I mean by that, like you can find a lender who will give you cash in 2 weeks or even 2 days. The costs are going to be exorbitant. There is not a you can pick, fast and cheap or, a little bit slower but more affordable, but you generally can't get both. And so there's diligence, there's the backlog analysis, there's an assignment of claims that has to be filed, and that's at the tail end. So there's a lot of steps involved. It does not mean it's a long time, but it's not instantaneous. And so I think waiting till too late in the process, it really pigeonholes the applicant, the borrower, in terms of not having the options they would have if they started the process a few months earlier or in anticipation of an award. That's probably the biggest thing.
what sort of financing options are there available for government contractors? If you could outline that a little bit, that would be great.
Let me give you the honest menu as I see it, including the ones that aren't necessarily something we offer, but I think it's important for folks to really understand the essence of what's out there. So I'd start with a bank line of credit. And that's generally the cheapest, hardest to get, probably the slowest. Usually you need to have collateral you don't have, SBA 7A working capital or cap lines. They're real options. Real government guarantee helps de-risk it for the lender. It's a real effort to underwrite those. And so there's a longer timeline. You also have factoring. So that's where you're selling a receivable. It works. It's expensive. It's invoice by invoice, and it does nothing for you before you have an invoice. So generally speaking, working with a factoring company only really helps if you're actually generating receivables or have invoices available to factor. I would also add, then there's us. So we have contract-based lenders. That's a revolving line sized against your actual contract value. So you only draw what you need, you pay interest only on what's drawn, and then the repayment options come through an assignment of claims when the government pays. So we're not underwriting your balance sheet, we're underwriting the award and also your ability to perform on that award. And then equity. I know it's not really the same as lending, but there are cases when the answer to the problem isn't necessarily debt, it's equity. And usually that comes into play if someone's not really profitable yet, or they're in a really aggressive growth phase. So, there's a lot to unpack there. That's a very high level overview, but it's really important. If there's one thing anyone walks away from this with, it's matching the instrument to the gap or to the actual issue. And so, like a 60-day gap needs a revolver. That's not an equity issue. So, really understanding what the precise need is to match it to the product, I think that's the critical thing here.
Awesome. Okay. And Charlie, how should financing for a contract become a part of their long-term growth strategy?
Well, I think that financing has to be part of their long-term growth strategy, right? I think that no matter what business you're in, whether it's government contracting or I used to say, a pizza shop, it costs money to be in business. You're constantly um, getting invoiced for things you haven't sold yet, right? So, or haven't collected money on yet. So, I think it's a major part of building any business in any strategy, specifically in government contracting, because of the terms that the government has, where you have to submit an invoice, 30 days, let's say, after work started. And like I said, in some cases, 30, 60, 90 days, or if there's a government shutdown, it may be even longer until you get paid. And during the waiting period, you're still incurring more expenses, right? There's still bills coming in and payroll that needs to be met. So I think it's a really important part of the beginning strategy as well as the growth strategy.
Eric, give me a little bit of the government payment cycle. If you can just kind of outline it very simply, how does it work?
Yeah, so I'm happy to walk through the whole thing because most people, I think, only know the last step. So,
And
and
that's
it's worth
getting paid, right?
yeah, that's right.
That's
Seeing the
getting
bank,
funded.
the numbers in your bank account going up. But it's important to go through this from a few different perspectives. So one thing I'll add is, I used to be a contracting officer, so I literally was part of the team on the part of the government processing the invoices and making sure that the vendors I was working with, they were getting paid. So the contracting officer, they're going to award the contract. The dollars are obligated, and that obligated amount is your funded value. Okay, so let's say you have a $10 million IDIQ ceiling, you have a task order for a couple million. The ceiling isn't the part you're getting paid on. That's just the limit. You perform the work, you're going to invoice. Could be wide area workflow if it's Department of Defense, different agencies. Some of them use different software suites or platforms to actually like process and track all the invoices and all of their vendors. But generally speaking, once you submit the invoice, that gets sent to the contracting officer's representative, the core. Sometimes it's the COTAR, it's the contracting officer's technical representative. But between them and the contracting officer, those are the two most important people for actually approving the invoice. Usually after that, once it is accepted, assuming there's no issues there, it gets routed to the financing office. So again, at the Department of Defense, DFAS might be something someone here is familiar with. But whoever the agency finance center is, they're going to essentially process that approved payment. Usually, once they're getting it, I think you're in the home stretch in the final 30 days. But again, that can vary, and it does vary. So the government, it is a good payer, but that's not where the friction is. The friction tends to be when you consider if the invoice is proper or not. And that's where you can run into issues with acceptance, with approval. Did certain service level agreements get met or not? The core might be on vacation. Who's their backup? There are a number of different reasons things can get delayed. But generally speaking, that's the process. I would say you can plan for 30 to 60 days on average, upwards of 90 in some cases if things are not as they should be. So I think 30 is an optimistic timeline. Um,
All right, Charlie, what happens when they're delayed, when payments are delayed? Let's hear your take.
Payments being delayed could be problematic for anyone, and especially if you're in a high growth phase or any phase, right? If you owe money and the payments, I think everyone's experienced that at some level in their lives, whether in business or not. Someone owes you money and you're waiting to get paid so you could pay other invoices, and it depends on your vendors and how long they're willing to wait to get paid. But it could be catastrophic in some cases. In the most extreme cases you could actually go out of business. Again, that's an extreme case, but you're certainly spending a lot of time calling people, maybe trying to borrow from other sources to make up for that gap. And I know we talked about, payments from the government 30, 60, 90 days, and 30 days is optimistic, but there's government shutdowns. There's all kinds of things that can happen, other than the invoice, not being filled out exactly right, which can also delay payment. So yeah, I think the answer is it can be very problematic. And on the low end, highly stressful.
Eric, why is specialty financing is so important?
yeah, so I think it's because a specialized lender can effectively view the contract as collateral. And I think simultaneously, most lenders can't read a contract and they don't understand the industry. So a generalist lender might look at $1 million IDIQ and they see the wrong number for what they view as cash flow. A specialist knows the difference between funded and unfunded backlog, task orders, MATOCs. You're dealing with someone who generally knows the industry because they come from the industry. A generalist lender is just looking at it in a very generic way. And when you lack of an understanding of something in the banking and financing world, uh, lack of understanding or ignorance equates to risk, and risk equates to we're not going to approve you. Right. So it's the difference between being approved and getting the cash you need versus not. And that to me is the biggest distinction.
So let me ask you this, Charlie. What should owners look for in a financing partner? I'm sure you have some very strong feelings about this.
I do. I think that contract indexed financing is the key here, right? Both for so it's an understanding of government contracting, and those payment cycles, and not only that, also the growth factor of a government contractor, right? So if you have a line of credit for a specific amount, say it's for $1 million, and you just won a contract for $5 million, a traditional finance or a bank, you'd have to go back and apply for an entirely separate loan. um, Contract indexed financing, that credit limit will move with your contract backlog. So the credit limit increases as you win more contracts, which is something only a GovCon lender would understand, that it's tied directly to that contract. And they also would understand in cases of a government shutdown or a delay in payment. They really, I would look for a lender that really understands um, the cycles and the contracts of a government contractor, so that the financing is coupled with that and it's specific for what they need at the time they need it. I call it just-in-time financing for government contractors is really what they should look for.
Eric, what happens when a contractor wins more work than they can support?
Well, it's a good problem to be dealing with. So I'd say this is arguably one of the more dangerous moments in a contractor's life, and it arrives disguised as good news, right? I've seen more contractors fail from too much work than too little. But here's why I say it. Here's the sequence. So you win something twice your current size. You staff up. You have to hire people. You're now carrying that higher payroll, and with that comes the lag that we've previously talked about of having to wait, 45, 60, 90 days to have that invoice approved and then paid. While your existing contracts still have to run, you still have to make payroll, you still have to pay subcontractors or other suppliers. So that's the version that's genuinely hard to recover from is you win that, you can't perform, you get a bad CPARS rating, and then that past performance follows you for every, or at least the next 5 years, 3 to 5 years, when you have to submit proposals. You have to include your past performance, and they're going to look at your past performance when they're evaluating you. So, that capital plan and just figuring out what you're going to do and how you're going to get the cash you need to avoid everything I just described, that belongs in the bid decision, not after the award. So before you submit, you have to know what the costs are and where the money is coming from. It's not something you can just put as a TBD, because that's a recipe for failure.
Okay, I'm going to tee this up to Charlie now. So, how can growth capital help you pursue those larger opportunities?
Well, I think growth capital gives you the confidence that you need, right, to bid those contracts, because I think that's always a worry. If you only have a certain amount of money in the bank or on the balance sheet, and you're trying to bid a job that is in the millions of dollars, and you'll need mobilization funding up front to buy supplies, and you'll need payroll, 2 weeks in, and you're going to need payroll again another 2 weeks later. You need a cash reserve, um, and you need to have financing in place to be able to bid those jobs with confidence, really, and then to be able to, as I say, punch above your weight and bid larger jobs. You want to have a financial partner in your corner, unless you're sitting on a huge pile of money, which most businesses are not.
Eric, what don't banks get? How do they misunderstand contractors?
I guess there's probably three misreads, and I think they're pretty consistent from one to the next. So one is concentration. So if, let's just say, one customer is over a certain percent of revenue, that's a big risk. But if your customer is the federal government, at the same, like, this is the counterpoint, we don't view necessarily that as being concentration risk. That's the highest credit quality payer available to anyone. So I think it just fundamentally comes down to understanding the uh, what we call, like, the account debtor, who's paying your uh, who's your customer, who's paying your invoices for the work you do. So that's number one. Number two would be a thin balance sheet. So I think a lot of banks will look at that, and by itself, absent anything else, that can be a non-starter. That can be a deal killer. So we think there's a little bit more nuance there. A services contractor, if you really think about it, they're asset light by design. So, the bank might not see any collateral, but what they're missing is that very critical, valuable, obligated money on the contract. That is the asset. Yes, it's not a fixed or it's not a tangible asset in the same way inventory is, but we do believe it is an asset. And then number three, I would say, is the backlog, contract backlog. So I think a lot of credit analysts, they can't distinguish a funded contract from unfunded. They don't know what's been billed versus what's still remaining. They're not entirely sure how option periods and option amounts or quantities work. And so they might not give you, the vendor, credit for a backlog that is actually a lot stronger than they might be understanding. And so I think that's going to really tie their hands when it comes to what amounts they might be comfortable lending to a federal vendor, if anything at all. And then if you layer in something like a continuing resolution conflict, or a shutdown on top of that, and the whole file it basically gets unbankable at that point. So I'd say, uh, it's not that banks are wrong, but they're applying a very specific underwriting framework to a federal borrower, and that framework often just doesn't fit.
You know what, Charlie? You said banks look backward while growth lenders look forward. What does that mean?
So the banks are looking at a snapshot, right? They ask you for your balance sheet, your tax returns, your financial statements. All of that is past-based data and information. So um, everything they're looking at is from the past. So for instance, if you're in growth mode, right, or you're trying to bid a contract that's larger than what's in your bank account, uh, there's no way to do that without someone looking forward and saying, okay, here, if they win this contract, they're going to receive X amount of money from the government. We'll take that bet, essentially, right? A funder that's looking at that saying, well, we think this contractor is going to complete this job. We think they're going to get paid for this job. We've seen their past performance. We're going to support them financially to be able to take on that larger job. And we don't, not that what's in the past is not important. Obviously, credit is important and balance sheets are important. But if that's all you're looking at, you're really not getting the full 360 view.
Eric, why are organized records so important for a contractor?
In federal contracting, your books they're not just a management tool. So they're actually a compliance deliverable, an artifact. And so they can actually act as a gate on what you're allowed to bid. So if you want to grow into like, let's say you want to grow into cost reimbursable work, you have to first prove that you have an accounting system that is adequate and that can meet the requirements of all the additional rules and layers of compliance pressure that you have to meet if it's a cost reimbursement contract. So things like job cost accounting, compliant timekeeping, segregation of direct and indirect expenses. Those aren't just like nice to haves. Like without that, there is a whole category of contracts that vendors simply can't pursue and get awarded. And then from our side of the desk, it's also how you keep your books, or I should say, how you keep your books is how I, as a lender, get a fast read on if I think we can help you, right? So, um, you know, when an owner can pull contract level cost detail out of whatever you're using, Uninet, Cost Point, QuickBooks. I know something about that operator before we've even discussed a number, if they can produce that information really easily. And then, conversely, when it takes 3 weeks to produce a contract level P&L, that tells me something too, and it's generally not a good thing. Uh, I guess if I were to summarize it, clean records make you financeable, they make you auditable and biddable. Like you can go after certain work that you might not otherwise be eligible for. Messy records are going to cap you wherever you are today.
Charlie, let's talk about financing and talk about technology and how that really helps the process of auditing and make sure that you're ready, audit readiness. Tell me a little bit about that, what technology is now bringing to this sort of business.
Yeah, I think technology is bringing a lot of opportunity for small businesses. It used to be more difficult to keep records of things, right? Now you could plug your bank account into your QuickBooks or your Uninet or your accounting systems, and they automatically talk to one another, and they could communicate, via API when a payment has landed or when a payment is due, and you could set reminders. So I think it keeps people more organized. I think it's even getting better, with AI notices. There's even automatic payments that you can set up, which everyone's done even in their personal lives or any kind of business, right? Where we used to not be able to do that, where you'd have to pay a bill when it came in the mail with a check. Now with technology, there's auto payments. So I think it helps keep, as long as you're using the technology correctly, and you're using it and utilizing it the way it's designed, which I've seen some people aren't, but if you are, I think it makes you um, have cleaner records, cleaner books, better payment history. And if you're in the government contracting space, it looks better to a contracting officer if you have everything together, because they need to trust you that you're going to complete this job and that you're going to fulfill your obligations, and your financial health is part of that.
Tell me how Alint is bringing this kind of state-of-the-art new technology to government contracting and how this is changing the landscape of how government contractors finance and operate.
Yeah, with Alint's innovative platform, we have tied together banking systems, accounting systems, and contract backlog, right, from sam.gov. So what we're able to see is really a full view of everything that's going on, and we're able to produce records and read records that previously were unavailable. It was all self-reported. So now with the technology, we're able to increase credit limits, give larger credit lines to these contractors so they could bid more jobs, they could take on larger jobs, they can grow their business. And that's all through technology. And in the event of an audit, which happens a lot in the federal government space, you are audit ready. I mean, you have all the documentation you need, everything's digitally produced. So, yeah, we're really proud of everything that we built.
What is it?
The technology is allows us to give in contract backed financing, right? So it's a dynamic credit limit that moves with your contract backlog. So you could bid more jobs more confidently, knowing that if you win that job, we're your financial partner. And that's possible because of our technology, where we don't have to bog you down with a ton of paperwork and submitting a ton of financial statements. We have everything we need, and we have visibility to be able to give you just-in-time financing via our technology.
And Eric, how does that bring, from your perspective, you've sat on both sides of the fence here. How does that really help facilitate the support for a government contractor, this sort of financing opportunity?
Yeah, well, the fact is that technology enables us to get a faster and more accurate read on the numbers. It's going to allow us to get more comfortable with the financing. So that means potentially saying yes in cases where a lot of more traditional, non-specialized lenders would say no. And then I think it also helps after the loan is closed with the servicing experience. And, it's not just getting a loan approved. There's also the whole experience of having to get the, draw requests processed and vendors paid and paying the balance down, right? We offer a revolving line of credit, so it goes up and down. So there's a lot more to it than simply getting an approval and hearing a yes to move forward. So I think on both sides of that decision point, getting through that application process and then actually getting serviced and working and hopefully growing as that backlog expands. To me, those are the big advantages.